Some analysts suggest that in the near future, oil prices may become negative, that is, oil companies will begin to pay buys for the possibility of supplies. How realistic is this scenario? The risks of subsidence in oil demand coupled with Saudi Arabia's promises to increase production by a quarter from 9.7 million barrels per day in February, according to OPEC, to 12.3 million barrels per day in April, raised concerns not only a landslide fall in quotes, but also their decline to negative levels. This forecast was made, in particular, by Mizuho Bank analyst Paul Sankey, who estimated that global supply now exceeds demand by 15 million bits per second, which could lead to a shortage of oil storage capacities in the coming months. As a result, manufacturers will have to pay buys for the very possibility of supply. A similar collision occurred last spring in the Texas gas market, where prices fell below zero due to unscheduled repairs to the El Paso pipeline, whose capacity fell by a third after the breakdown of 2 compressor stations. As a result, upstream companies operating in the Perm Basin on the Texas-New Mexico state border were faced with an excess of associated gas produced by oil, the prices of which reached negative values at the local water hub, from -10 cents to -$4 per million British thermal units, as follows from Refinitiv data. Presenting something like this in the oil market is still difficult. First of all, because of the relatively high availability of American oil storage facilities, such as in Cushing, where oil traded on the New York Stock Exchange is stored and where, according to the Energy Information Administration of the United States Department of Energy, storage capacities were filled only by 51 March, 7% 38.5 million of 74.4 million barrels, and the country as a whole, where they were involved by 58.4% 453.7 million of 777.2 million barrels. For comparison, on the 13th of December, long before the coronavirus epidemic unfolded, these rates were 54% and 57.5%, respectively. Such an imperceptible difference is probably due to the fact that the oil industry has not yet had time to feel the contraction of global demand. According to the March projections of the International Energy Agency, in the first quarter it should decrease by 2.4 million bpd, to 96.7 million barrels per day against 99.1 million barrels per day in the first quarter of 2019. And for the year as a whole, by 90,000 barrels per day, up to 99.9 million barrels per day. Actual, rather than projected, consumption has not changed much so far, and confirmation of this is the dynamics of American oil imports, which in the first 2 weeks of March 6.4 million and 6.5 million barrels per day, respectively, was only slightly lower than the January level, while exports in the second week of March, for the first time in the history of statistical observations, the Energy Information Administration, since 1991, exceeded 4 million barrels per day, reaching 4.4 million barrels per day. In European and Asian countries, ahead of the US in the implementation of antiviral measures, demand began to sag a bit more, and even then only in recent months. This is evidenced by the statistics of shipping by Refinitiv, having increased in 2019 by a little less than 0.1% up to 388.9 million tons. Eurozone maritime oil imports in January decreased by 3.5% in annual terms, to 33.2 million tons, and in February, excluding supplies on the 29th of February, by 9.2% up to 28.2 million tons. A similar trend is characteristic of China, Japan and South Korea, the total sea import of which in 2019 increased by 5.3% to 745.2 million tons, and in January and February decreased by 1.8% and 4.7%, respectively, up to 65.6 million and 56.9 million tons. This partly explains why Saudi Arabia has not yet managed to seriously increase export shipments. In this regard, the current drop in Brent and Urals quotes, which for the first time in a long time fell below $30 and $20 per barrel, is associated not so much with the actual contraction in demand, but with uncertainty about how long and large scale the impact of coronavirus on the oil market will be. As soon as such certainty looms on the horizon, prices will inevitably wait for a rebound, possibly to the corridor of $40.50 per barrel, the return to which seemed quite realistic in the first days after the OPEC deal was broken. In the meantime, market participants will have to reap the fruits of fear, the benefit of which will be the owners of oil supertankers, whose rental prices have jumped sharply, including due to the need of companies for additional storage capacity for the period until prices recover. For example, Shell, according to March reports by Argus, rented 2 oil supertankers Sea Lion and Sea Pearl for 5 months at an average rate of $40,000 per day, while the cost of freighting supertankers from the Gulf of Mexico to China for the second week of March increased by 107% to $55.60 per ton, and from the Middle East to East Asia, by 213% to $42.20 per ton. Freight rates will probably continue to increase in the coming weeks, unlike oil quotes, which, however, are unlikely to drop to negative values. United States and Saudi Arabia Oil Alliance. Officials from the U.S. Department of Energy urge the administration of President Donald Trump to create an alliance with Saudi Arabia for the oil price regulation, according to the Wall Street Journal. It is assumed that such a decision will avoid serious collapses in oil prices, and may also weaken the partnership of Saudi Arabia with Russia. As the newspaper points out, this could lead to the kingdom quitting OPEC. It is noted that several variants of the oil union are possible, one of which involves the use of national oil reserves. According to the publication, the plan is being discussed at the ministry, but has not yet been approved by either its leadership or the White House. In early March, the OPEC countries were unable to agree either to change the parameters of the agreement to reduce oil production, or to extend it. Saudi Arabia insisted on an additional reduction in production, but this did not suit Russia, which proposed to maintain the existing conditions. As a result, from the 1st of April, participants in the OPEC transaction will no longer have any obligations. After that, Saudi Arabia announced its intention to increase production, lower prices and offer large volumes of discounts to European customers. This collapsed oil quotes in world markets. Since the beginning of the year, prices have more than doubled down. Saudi shock and awe tactics overwhelm United States shale companies. Of Republican senators sent a letter to the Saudi government to support the price war. However, so far there is little evidence that a dozen American senators will convince Saudi Arabia to change course. In any case, the senators' attention to the overabundance in the oil market is a cause for concern amid the spread of the pandemic. In Bergamo, the death toll is so high that on Wednesday they had to use the forces of the army to move coffins with the bodies of the dead. The number of deaths from coronavirus in Spain is growing. The spread of the virus is accelerating in the United States. In the United States, there is practically no testing for coronavirus. Medical equipment in most of the country is not enough. This shortage will be felt for several more weeks. The Centers for Disease Control and Prevention recommended that healthcare providers use home masks, such as bandanas, scarves to care for patients with COVID-19. However, he added that it is not yet known how effective they can be. Most of the country is forced into isolation, which exacerbates the economic crisis, which could be exacerbated by the financial crisis. The reality is extremely simple: the coronavirus has affected everyone. Oil companies will not get out of the abyss until governments cope with the pandemic. If politicians do not decide to allow thousands, or even millions, of elderly and sick people to die from COVID-19, the virus could end in a global stop. At any other time, industry-specific media would be engrossed in speculation about Saudi Arabia's motives and potential exit strategies. But now everyone is getting acquainted with the latest developments, writes JBC Energy. Of course, Saudi Arabia is dealing a considerable blow, flooding the oil market during the economic crisis. But an increase in supply of an additional 2-3 million barrels per day is nothing compared to a decrease in demand of 10 million barrels per day. JBC says oil price fluctuations are increasingly happening amid daily news of the pandemic, no, OPEC. Therefore, the quickest way out for the oil industry is for governments to slow the spread of the pandemic. The economic crisis will be resolved only when it succeeds in coping with the health crisis. However, some oil company executives do not think so. On Thursday, Harold Hamm of Continental Resources issued a press release, the essence of which is completely divorced from reality. The company announced a 55% reduction in capital expenditures by 2020. However, then it quickly shifted from the numbers of capital investments to the illegal decline on the part of Saudi Arabia and Russia. This is a short demand cycle that will lead to a short-term correction when illegal dumping practices end, Continental said. To call the strongest decline in demand in history a short demand cycle is completely wrong. It is also completely wrong to believe that a short-term correction is possible if the US government starts anti-dumping operations. Other shale companies resign to their fate. The list of drilling companies that are at various stages of studying debt restructuring includes Whiting Petroleum, Antero Resources, California Resources, Chesapeake Energy and Gulfport Energy. Occidental Petroleum sharply reduced dividends. However, this did not save the company from the fact that Moody's lowered its credit rating. Shale oil production will not fall immediately, since exploration and production companies that have already drilled wells will bring their projects to the end in order to recoup at least part of the cost. At the same time, Canadian oil companies are in even worse shape, as WCS fell to $7.47 per barrel on Wednesday. According to Bloomberg, manufacturers of oil sands will not be able to easily reduce production, preferring, rather, to work with losses. If WCS remains low for several months, manufacturers will begin to close production. The leaders of the shale companies and their Republican allies are right about one thing: Saudi Arabia will outlast Texas drilling companies, despite the fact that the United States supports the idea of energy dominance. Manufacturers can drop out of the business en masse, some will never be able to return to it again. And in a year Saudi Arabia will be able to sell 10 million barrels per day for $40 instead of 7 million barrels for $50, concludes JBC Energy. Russia no, Saudi trick and the new oil order. On March 6, Russia surprised OPEC by rejecting a Saudi offer to cut oil production by 1.5 million barrels per day due to a slowdown in economic growth in Europe and the United States and a sharp decline in demand, up to 20%, in China, exacerbated by an outbreak of coronavirus. As a result, prices fell 30% to $32 per barrel, which is the largest collapse since the 1991 Gulf War. The offended Saudi sheikhs reacted in an even stranger, almost unnatural way. They announced a reduction in oil prices by $5 for Asian countries, $6 for the United States and $8 for European consumers, who are Russia's traditional customers. In addition, they announced that starting from the 1st of April, OPEC countries can produce as much oil as they see fit, despite the fact that the market is oversaturated and the storage possibilities are not unlimited. Thus, Moscow temporarily stopped playing Russian roulette of cooperation with OPEC, which began in 2016, when it was agreed to reduce production in order to increase the price, which fell by half from $80. It should be noted that, although Moscow supported this reduction, prices did not rise significantly. Given that the price of oil is determined by politics, not by the law of supply and demand, let's look at the motives of the two energy superpowers, which together produce 21 million barrels of crude oil per day. Here are the true motives of the Saudis. 1. Collapse the Russian economy, at the same time creating favorable conditions for the shale oil of its American allies, who showed tolerance for Saudi Arabia after the vile assassination of the journalist Khashoggi by the Saudis and went in line with the requests of the same Saudis to impose sanctions on their sworn enemy Iran. Riyadh did the same in November 1986, dropping prices by 75% to $10 per barrel, which inflicted a mortal blow on the Soviet economy, which could not properly respond because it was planned, and not planned, as it is now. To understand the whole politicization of this issue, it's enough to recall how Trump, worried about the upcoming congressional elections in November and the price of oil at $85 a barrel, ordered King Salman, reduce the price of oil now, and having been refused, threatened, "You can lose the throne in 2 weeks," and His Majesty had to lower the price to $67. 2. Amid the current economic crisis and market volatility, Saudi Arabia is seeking to regain its leadership. 3. To reduce the volume of shale oil, which the United States already produces in the amount of 13.1 million barrels per day, of which 4.15 million are exported. 4. To inflict even greater harm to his sworn enemy Iran, whose oil industry is already under US sanctions. Here are the true motives of Russia. 1. To undermine the production of shale oil in the United States, which, with current technology, will not withstand prices below $45. 2. Attract US customers. 3. Reduce Washington's ability to impose sanctions on Russia. The almost completed construction of the Nord Stream 2 gas pipeline, through which Russian gas will be delivered to Europe, will not budge. 4. To expand the circle of buys, given the absence of Iran and Venezuela on the market, as well as interruptions in oil supplies from Nigeria and Libya. And, consequences of price war. 1. A price war could lead to bankruptcy and/or a violent merger of U.S. shale oil producers and leave thousands of extractive industry employees unemployed in the election year for Donald Trump, whose energy policy is different from his predecessors. The president instructed the U.S. Treasury to purchase significant amounts of cheap oil for the Strategic Oil Reserve in order to enlist the support of the largest Chevron and ExxonMobil corporations, rather than hundreds of small and medium-sized investors of shale oil companies that are either deep stuck in debt, or even went bankrupt, say, in Texas. And as a cherry on the cake, he did this when the coronavirus spreads with might and main, and most of the population in his country do not have health insurance. 2. The growth of the budget deficit in Saudi Arabia. Although the cost of oil production in the country is about $3 per barrel, the kingdom, whose budget deficit is already $50 billion, requires an oil cost of at least $80 to balance its budget, and also continue the war with Yemen. Moreover, the Saudi authorities will have to face growing social discontent. The arrest last week of 300 people, including representatives of the nobility, the military and officials, shows the instability of royal power. 3. The free fall in shares of Saudi Aramco, by 9%, which began to cost less than its initial public offer. This entailed, the discontent of thousands of citizens, about 20% of the population, who acquired the shares of the company, some even taking a loan to become its investors. B. The need to extend saving measures in relation to wages of workers. C. Damage to the authority, if he ever had, of Crown Prince Mohammed bin Salman, who initiated a large-scale infrastructure development project, which was supposed to reduce the country's dependence on oil, and now has remained without the income necessary to finance it. This game, started by a loser prince who destroys everything he touches against such a wise and cunning politician as Putin, turned out to be too risky. 4. Despite the fact that Russia has partially reduced its dependence on oil revenues and when drawing up the budget it proceeds from a price of $45, Saudi Arabia always put $65 in the budget. Low prices can affect not only its economy, but also its popularity. President Putin, because it was thanks to high oil prices in the 2000s that he managed to carry out important economic reforms and gain real support from the people. Since now he intends to ask the people for an opportunity to run for the period until 2036, he needs oil worth more than $60. 5. Enormous damage will be caused to Iran, whose oil industry is under severe U.S. sanctions. Iran appealed to the IMF for a $5 billion loan to fight the coronavirus. If this request is granted, the debt of this fabulously wealthy country by international financial organizations will become even greater. 6. There will be a fatal blow to OPEC for the following 3 reasons. Now each member of OPEC can act as it sees fit. B. OPEC countries will lose billions of dollars in profit. C. Russia is being distanced from the cartel. 7. All this is beneficial to China, which consumes 13% of world oil production, and among its suppliers appear Russia and Saudi Arabia. The war of Saudi Arabia with Russia and Russia with the United States may intensify and lead to new changes on the world's energy map, up to the establishment of a new oil order with many unknowns.